so let's take a look at how we can use contribution margin to calculate break-even sales and break-even sales dollars. So we know how much we need to sell in order to just break even. That's a really good number for a lot of business owners. So back to our cruise line example. Crystal Cruise Line offers nightly dinner cruise off the coast of Miami, San Francisco, and Seattle. Dinner cruise tickets sell for $50 per passenger. Crystal Cruise Line's variable cost of providing the dinner is $20 per passenger, and the fixed cost of operating the vessel, meaning depreciation, salaries, docking fees, and other expenses, is $210 per month. Company's relevant range extends to 14,000 passengers. So they want us to use that information to compute the number of dinner cruise tickets that Crystal must sell to break even, and then the number of dollars that they need to break even. So I've gone ahead and posted the formulas here for us. I'll save a little time. And break even sales is fixed costs. Let me write in here. We should have a divided by line, divided by contribution margin per unit. And then in sales, very similar, fixed costs plus any targeted net income divided by the contribution margin ratio. And again, I put the contribution margin ratio formula here, which is contribution margin per unit divided by sales price per unit. So let's go ahead again real quickly. We'll calculate the contribution margin, which is our sales price minus our variable cost. So sales are $50 per passenger. That's the cost per passenger, minus the $20 variable cost, which is the cost of providing the dinner. So the contribution margin per passenger is $30. So in this particular example, if we know that our fixed costs are $10,000 per month, and they're not asking us for any targeted income, so we'll just leave that at 0. And then we divide that by the contribution margin per unit. Well, we just calculated that at 30. So 210,000, sorry, this is a little messy. 210,000 divided by 30 should give us a contribution or a break-even sales number of 7,000 passengers. So they need 7,000 passengers at a sales price of $50, variable cost of $20 to break even 7,000. Okay, so then it asks us to compute the dollar break even, so they know how much revenue they need to bring in order to break even. And it's a quite similar calculation. Fixed costs, which we know are going to be $210,000. Again, there's no desired target income, it's just a straight break even, divided by the contribution margin ratio, where the contribution margin ratio is the contribution margin per unit, which we determined to be $30, divided by the sales price per unit, which is $50. Okay, so we know then this is going to be 210,000 divided by our contribution margin ratio, which happens to be 60% or 0.6. 210,000 divided by 0.6 means they need to sell or bring in $350,000 worth of revenue in order to break even.